The early years of a startup company often comes with incurring heavy losses as the company spends a lot of money on marketing and R&D. Now, these losses come with a hidden benefit in that they can be used to offset the tax liability when the company becomes profitable. Q4 2023, Tesla announced earnings, a net profit $8 billion, out of which there is $6 billion that came from what, Jeff?
The release of a valuation allowance.
Now, this video is going to explain how all of this works. So if you're involved with a startup company, you're going to want to stick around for this. Let's go. All right, guys, welcome back to the channel. So in today's video, we're talking about the idea of turning your losses in a startup company, typically the losses in the early years, to a tax benefit for future years when the company becomes profitable. So this discussion here is both strategic, how to turn these losses early on into NOLs or tax benefit for the future, and the accounting side of it. So the accounting side is just debits and credits. We'll go through an example showing how to set up the tax asset and how to use it when the company becomes profitable and all the journal entries that go into doing all of that. So for that, we have here Jeff Cherko, who is a tax director. Welcome back to the channel.
Thanks, Bill. Happy to be back.
All right. Good to have you. So Jeff created an entire course on the entire topic of starting up the company and creating the tax provision, creating the valuation allowance, share-based comp, all of the things that go into the corporate tax accounting under ASC 740. So you'll find the link in the description for this course. But for this video, we want to talk about this because this became a hot topic recently with Tesla, right? Q4 2023, Tesla announced earnings, net profit $8 billion, out of which there is $6 billion that came from what, Jeff?
The release of a valuation allowance.
Okay, which means almost nothing to me from someone who's not in tax, the release of a valuation allowance. So we are demystifying this part of it today with an example and going through this step by step. So let's dive right into it.
Let's do it.
All right, so Jeff, we're talking about this like a story because we love stories. So you work at a startup company or you start a company yourself, right? Early on in the company, there are losses for a number of years. I don't know, 5 to maybe 10 years of losses until you maybe become, a viable business and you make money, right? So why is the IRS or the relevant tax authority is allowing you to have this sort of benefit, right?
Sure. So most tax authorities around the world allow you to carry forward your losses to a future year. And the thought is you've lost money and in one year, and then maybe the next year you make money, you can use those losses to offset gains in a future year. Some tax authorities have expiration dates on those NOLs. They have to be used before, say, 10 or 20 years. And some NOLs carry forward indefinitely. In the case of the IRS, there used to be a 20-year carry forward for net operating losses. And with the passage of the Tax Cuts and Jobs Act in 2017, they said for NOLs after the passage of the act, those NOLs have an unlimited carry forward period.
Okay, gotcha. So it's a carry forward, not carry. It cannot carry it backward.
It depends on the jurisdiction that you're operating in. Some jurisdictions do allow for a carryback. The IRS no longer does with the passage of the Tax Cuts and Jobs Act. But there used to be provisions for NOL carrybacks. And then some of the states have NOL carrybacks and some of them are just carry forwards.
Gotcha. Okay. So when you say NOL, this stands for net operating loss.
It's your net operating loss. It's your taxable loss. So this is not your pre-tax book income. It's the taxable income. It's a taxable loss on your return that you're then carrying forward.
Great. And I just want to remind you guys that if you're liking this right now and you're getting a value out of it, feel free to hit that like button because that's how we benefit from it by spreading this video around. So, all right. So we talked about the subject of the IRS or the tax authority allowing you to carry forward your loss to a future year. That, in my understanding, translates into the creation of an asset. Is that right?
It does for accounting, yes.
Okay. So let's talk about that from the layman's perspective. You create an asset. How does this asset get created about? Because assets are bought. When you want to have an asset in your book, you either earn it or buy it, right?
Generally
Okay.
speaking, yes. In this case, the loss is generating an asset that you're going to use in the future to offset taxes payable. And I would think about it like a gift certificate, right? You have this loss, and let's say you have $1 million loss, and now you have this $1 million NOL that in the future, when you have $1 million of income, you're going to be able to use it, and it's going to result in cash tax savings, right? And so that gift certificate, as we're using analogy, it becomes an asset that you record on your books.
Yep, I love the gift certificate analogy. So it's a gift certificate, but just to clarify, if you have a loss of $1 million, your gift certificate is not $1 million. Your gift certificate is $1 million times the tax rate.
The tax rate. So the million loss will generate an asset of the million times the tax rate.
Okay, so if your tax rate is 20% or 21%, that's 210,000 whatever on that. That becomes your asset.
Yeah.
Perfect. Okay, so now that we demystified the idea of how this asset is created, because a lot of us thinking of an asset as something that you buy or you earn through maybe making sales as accounts receivable. This is an asset that gets created out of losses, right? And it's an asset because it has a future economic benefit. You'll benefit from it.
Absolutely.
Perfect. So let's jump into the Excel example that we got, just so to drive this home a little bit more. And this Excel file you'll find in the description of this video. So feel free to go and download this file if you want to play with it and understand it a little bit more. All right. So what are we looking at, Jeff?
So we're looking at a startup company's financials, years 1 through 5 in this first piece here. So what we're doing here is we're showing pre-tax book income from a U.S. GAAP perspective.
And it's a loss in this case.
And it's a loss. It's a loss. Each year is showing a loss, which is typical when you have a startup company. They're investing in the business, and they just haven't reached that level of profitability yet. We put in here a blended tax rate of 25%. And for the purpose of this example, we're ignoring book tax adjustments, permanent adjustments, temporary adjustments. So we're basically just kind of showing that the pre-tax loss becomes your taxable loss in this case, which in practice is not the case, but we want to make this simple and as straightforward as possible.
But if you want to understand the nuances of the temporary and permanent adjustments, that's what the course is for.
The course covers those topics for sure.
It goes deeper into that. Okay, perfect.
So let's look at year 1. In year 1, you have a pre-tax loss of $300 million with a tax rate of 25%. And so that yields a tax benefit of $75 million. So in this case, we didn't pay any tax to the government, right? Because we had a loss. That tax benefit represents the future benefit of those NOLs, like we just talked about. So the journal entry to record this would be to debit your deferred tax asset, DTA, for $75 million, and you would credit the tax benefit. This is the income statement. Okay. And so each year we would have that same journal entry, years 1 through 5, and you'd be building up this asset on your books, and you'd have this P&L benefit coming through your income statement. Now, the trick here is that their US GAAP, ASC 740, says that we have to analyze our deferred tax assets for realizability.
Okay.
Are we going to actually get to use this asset at some point in the future?
And this is the catch here, right? Because the government is saying you can have this asset, but...
Well, it's really not the government, right? So the government in this case, let's say we're in the U.S. and this is, post the Tax Cuts and Jobs Act. These NOLs have no expiration date.
Okay.
But from a financial reporting perspective, you still may never, because in this case, this company has never shown a profit. This company may never show a profit, in which case that NOL would never be used. That DTA would never be used. And so ASC 740 says we need to look at these DTAs and determine if they will be realized. And the threshold for realizing a DTA for this purpose of putting up a valuation allowance is more likely than not, which is a fancy way of saying more than 50%.
Okay, so that's the comment. That's that second journal entry. That's sort of a reserve against the asset.
That's absolutely right. It's a reserve. The valuation allowance is a reserve against the NOL DTA that we have recorded in journal entry number 1. So I would think of the valuation allowance similar to how you would think about a reserve for bad debt. You have this asset of accounts receivable on your books, and there's part of that asset that you don't know if you're actually going to see the benefit from, and so you have this reserve against it.
Reducing the accounts receivable balance. Here too, you're reducing the deferred tax asset balance by a valuation allowance, except that with an accounts receivable, your allowance is typically a portion of accounts receivable. And this example is not a portion, it's a large chunk, or all of it.
It's the whole thing. So in this case, where we don't have other temporary differences, where we're using the simplified example, the entire DTA is made up of NOL. And in order to use that NOL, we would have to show that this company at some point will become profitable. And after year 5, we've had a history of losses with no profitability. It's hard to make that case that this company will eventually turn profitable. Typically, like the general rule is that your auditor will want to see 3 years or 12 consecutive quarters of profitability before they're really going to start having a serious discussion about releasing that valuation allowance and allowing you to recognize that asset on your balance sheet.
Okay, when we say releasing the valuation allowance, aka what Tesla did in Q4.
That's right. Okay. So Tesla had years of losses, and then they started making money. And as they showed a continued trend of profitability, they were able to say that more likely than not, they would use the remaining DTAs that they have on their books for which a valuation allowance was recorded. And they released or reversed that valuation allowance, which when you release a reserve, it has a P&L benefit. It's basically the P&L benefit that you did not take in those early years that now you're taking all at once.
Perfect. Okay, so we'll show the journal entry for that in a second, right?
We will.
And so far, you might have questions on what we're talking about. Feel free to hit the comment section below, ask us your questions, and we'll do our best to address these questions.
So on the next slide, we're looking at years 6, 7, and 8, where the company has now reached a level of maturity and is experiencing profitability. This is the hope, right, for most companies. And so the first in year 6 and 7, where there is income, but we still have the valuation allowance, you can see in journal entry 1 that income generates tax expense. But we're using some of our DTA to offset that tax expense.
So you're chipping away at the asset at this point.
We're chipping away at the asset, so we're releasing a part of that valuation allowance as we use that asset. And just in a similar way that in the early years, the valuation allowance offset the tax benefit, here the valuation allowance is offsetting tax expense.
This is not difficult at all. This is
so intuitive, very easy to follow. This is why everyone loves tax.
God, that's why everybody hates tax. Okay, all right.
And then you can see at the end of year 6, where there's been 3 consecutive years of profitability, the company is able to make the argument that it's more likely than not that the remaining NOL DTA will be used, and so they release the remainder of the valuation allowance, which results in this big tax benefit coming into your income statement all at once.
That's what Tesla did, right?
And that's what Tesla did. Yeah.
Okay. Okay.
I'm sure it was much more complicated what Tesla did, and there was a lot more things that went into it. Again, this is as simplified of an example as we could put together.
Exactly. Yeah. So that's an important point to stress. This is a simplified example. It doesn't include all the nuances of temporary and permanent differences. These numbers will look completely different.
Tax credits and different jurisdictions and things like that.
Yeah.
But
yeah. Perfect. Okay. So again, all of this plus all of the other nuances that we talked about is discussed in the Corporate Tax Academy by Jeff Cherico. Check it out. The description below has the course plus a coupon code that you can use when you buy the course. And this course is about close to 5 hours of video lectures recorded by Jeff here. I don't know how he packed it all together. He packed so much material in that course. Comes along with templates in Excel that shows real life examples of all of the temporary, permanent differences, provisions, transfer pricing examples, consolidation of multiple entities. It's a wholesome course on corporate tax, taxation under ASC 740 under US GAAP. Okay, good.
that was a great video. Thanks for having me, Bill.
That's good. What else? Let us know what else you want to learn in terms of taxation, right? So we got a good resource here, Jeff. We're going to use them. Whatever you got, any topics, let us know in the comment section below. We're not going to do all of them, but we'll select the ones that make sense, that are repeated requests to make. All right.
Sounds great. Can't wait to be back.
Yeah. Thanks for watching, guys. See you in the next one.
Did we nail it?
I think so. Okay, so can you, for fun, just say it 5 times? I'm making a mistake.
Tax Cuts and Jobs Act, 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 Tax Cuts and Jobs Act.
Shit, you did it. All right. Good.
Nailed it.